Okay, it's 12:02, and thanks everyone for joining us today for our webinar. After weeks of negotiations in the House and the Senate, on the 4th of July, President Trump signed the One Big Beautiful Bill Act into law as planned. At its core, the tax provisions of the bill are an extension of key provisions from the 2017 Tax Cuts and Jobs Act that were scheduled to sunset at the end of 2025, with significant implications for individuals, business owners, and charitable organizations. Today, our tax planning attorney, Michael Lee, will provide insights and analysis of the key tax provisions of the One Big Beautiful Bill Act, and also will discuss some wealth planning opportunities. First, I'd like to introduce ourselves. My name is Xiaowei Li, and I'm a partner with RUI Attorneys, and I specialize in estate and trust planning. Together with me is attorney Michael Lee. Michael, could you please introduce yourself?
Greetings all. It's good to see you. I'm Mike Lee, one of the partners in the office. So really excited to talk to you about the OBBBA.
Or OBBB.
Yeah. Oh, yes. Well, the One Big Beautiful Bill Act. So we got an A on there too. But yes.
Sure. There are two versions, I heard.
Yes. So great.
Yes, our webinar is for educational purpose only. So if you have a specific question, please reach out to us and schedule a consultation with us. Okay, without further ado, Michael, feel free to start your today's presentation.
I couldn't resist this joke, the One Big Beautiful webinar. And then that was a picture. I was in DC a while ago, and I walked by. That's the entrance to the official IRS out in Washington, DC. So I thought it apropos of what we're talking about. So let's move on to the OBBB, our One Big Beautiful Bill. So let's go on to the next slide here. So what is the One Big Beautiful Bill Act? This is a big bill. Its beauty is in the eye of the beholder. That that old quote that there is no beauty that hath not some strangeness in its proportions, and I think this is probably one of those. This tax bill, this significant bill, is a really massive, comprehensive adjustment on many areas of the U.S. federal tax law. It is extensive. What we will be talking about today really is mainly for individuals and for estates. So individual and estate taxes. There is a long list of things that the OBBB affects as to businesses. We won't be talking about that today. That's a very different style topic. So essentially, what is this? This is actual federal law that adjusted the U.S. tax code, so Title 26, the IRC, and of course, a number of other areas were affected too, but we're just talking about the tax parts. So it is a massive, essentially, Tax Cuts and Changes Act that follows up on the 2017 Tax Cuts and Jobs Act. As likely many of you were following the Tax Cuts and Jobs Act, likely regarding the estate taxes that we were going to have to sunset at the end of the year, that many provisions of the Tax Cuts and Jobs Act were going to sunset. Well, many of them are not going to sunset anymore. Many of these things are going to be made permanent. But then there are some other areas that did become terminated by the beautiful bill, and we're going to go through a few of them. So it's essentially, a large part of it is the Tax Cuts and Changes bill. It adds some fiscal stimulus for growth in 2025 through 2028. But in 2029, some of the individual tax cuts will expire and most of the spending cuts will come in. So there are some parts of this that are timing related, and we'll note that as we go through. This bill does appear to add to the U.S. deficit, which is significant, and it does raise the U.S. deficit quite substantially. So this issue with the raising the debt ceiling may not occur again and be discussed in Congress until 2026 or perhaps 2027. So let's see what we've got in our beautiful bill here. on to slide 2. Great. So one of the things that is, to a significant extent, good under the Big Beautiful Bill is it does permanently extend the current individual tax rates. So the current tax rate now for ordinary income is 37%, and then this is effective after 2025. So it is extending the current individual rates. We're not going up to the top income tax rate of 39%. It's going to stay at 37%, and this is permanent. So we have the 2025 rates, and then going forward, it's going to stay on these rates. It also permanently extends the increased AMT exemption amounts from the previous sunset. There was going to be 2025. So it increases that phase out amount from the 25% to 50% and modifies those inflation adjustments. So overall, with the core individual tax rates, we're going to be basically seeing the extension of the current rates, and we're going to see this increase in the AMT exemption amounts, which basically means your potentially chances of crashing into the AMT are less likely, which is good because the AMT is problematic. So that's the lay of the land initially. Let's go on to our next bit here, slide 3. This is a big one. This one is good for Californians. So what this is, we all call it in the tax biz the SALT deduction, but what this is the state and local tax deduction. And in the Tax Cuts and Jobs Act, the old 2017 bill, that bill actually took a punch at Californians, New Yorkers, people in New Jersey, with this thing called the SALT cap. And basically what the SALT cap was in the 2017 Act is that the amounts that we pay for state and local income tax and property taxes prior to the 2017 Act, we were able to deduct those on the federal return, the 1040, and get a deduction for our state and local taxes. And that was good for those of us in California in high tax states. But that 2017 Act capped it at the amount of $10,000. Well, and that's $10,000 of taxes. So the problem with this is that basically anybody that has a property that's that has a tax basis of $1 million, that used your tax deduction, and everything that you paid in state income taxes, you got no further deduction on that. So this was bad for Californians in the 2017 Act. The beautiful bill raises the cap up to $40,000 and this starts in 2025, and then there will be increases from 2026 through 2029. So this full deduction can be claimed for couples filing jointly if your modified adjusted gross income is less than $500,000. If it goes up, there are phase-out deductions as as your income goes up. But for couples earning less than $500,000, you will get a relatively significant deduction for state and local taxes. The only thing with this, though, is that similar to what we were seeing before in the 2017 Tax Cuts and Jobs Act, is this will sunset eventually. So there's going to be a reversion in the law as 2030. So in 5 years, we will go back to the $10,000 cap, but for the next 5 years, we have some good deductibility here. What does this mean? What are some planning opportunities here? This is a further opportunity to begin to plan to try to achieve income shifting. So if I am receiving ordinary income from my salary and I'm receiving rental income, maybe I may want to consider, if I have adult children, perhaps trying to shift the rental income or shift some income, doing some strategic gifting to income shift this income into the lower tax bracket individuals to lower my modified adjusted gross income so that I can take a higher SALT deduction, and then they can take a SALT deduction as well. So there is some deduction planning here. This is also attractive for perhaps using non-grantor trusts. So we'll see later in our webinar that the estate gift tax exemption that was going to sunset at the end of the year and was causing some panic in every planner's office. That was going to sunset to 7 million. Well, that's now going to be made a permanent, starting 2026, permanent $15 million exemption per person. So a husband and wife, $30 million. So for many families, this will allow much greater ability to do gifting, to do substantial gifting, and combining this substantial gifting with non-grantor trusts can be potentially a very effective strategy to, of course, lock in these estate tax exemptions for the far future and do income shifting to try to better achieve the SALT deduction year over year on the return, at least for the next 5 years. So this is quite helpful for us in California, and was a big sticking point in negotiations for the big, beautiful bill, because this was really harming Californians because we were paying very high state and local taxes, but not being entitled to the federal deduction, which we used to be entitled to. So this is I'll say this is a beautiful part of this bill. So this one, SALT deduction, quite good. Let's move on to the next thing that we have. The other thing that we also have, this is helpful perhaps for filers that have simpler returns, is that the standard deduction is also permanently extended to increase the standard deduction that was under the Tax Cuts and Jobs Act, that TCJA, that's the 2017 Act. It is now made permanent. So that was, again, going to sunset at the end of this year for the next year. It's not going to do that. So it will increase these standard deductions, 15,750 for single filers, and then 31,500 for married couples filing jointly as indexed for inflation. But with the SALT cap increased, we may not have as much standard deduction claiming in California, because depending on how the return looks, you may have better advantages itemizing and then having the SALT deduction and various other deductions that still remain there. So that standard deduction, that's looking good there. So let's go on to our next thing. Now this gets a little complicated. There is going to be an overall limitation on itemized deductions for high income earners. So for individuals taxed at the top 37% rate, the value of the itemized deductions would be capped at 35%. So there is an issue here about top marginal bracket earners and their ability to use itemized deductions. So there will be this capping at 35% for the itemized deductions for top income earners. This loops back to the suggestion mentioned before of planning opportunities with the SALT deduction as well, is because we do have some capping or phase outs of the SALT deduction and the itemized deduction. So looking at an individual that may be in the highest bracket, we would want to start taking a look at, are there opportunities to income shift? Are there assets that we can try to perhaps do strategic gifting to aim income at a lower generation, often via a non-grantor trust, so that we are not sending income through the main taxpayer and exceeding, ending up in the top brackets and then ending up with reductions in deductions. Reductions in deductions, that rhyme, we don't like that one. That one's not good. And with the SALT increase, we may be seeing that. So there is a limitation there. Another sort of factor auguring in favor of estate gift tax planning. So let's keep on going through. This also has changed. And this is actually a little bit more complicated than we've laid out here, but this is another area that there was going to be a potential sunset on this and a modification, but the beautiful bill changes this as well, is the child tax credit. This will permanently increase the child tax credit from the current rate of $2,000 to $2,200 starting in 25, and then it will index for inflation thereafter. But there is a phase out for this, and the phase out is somewhat complicated how it gets calculated. So for single filers who are over $200,000 or married filers over 400, there are going to be phase outs for the child tax credit. The other thing that is a factor in the big, beautiful bill that you will see routinely is that the taxpayers and the qualifying children must have a Social Security card number. Built into the beautiful bill are many, many immigration provisions. So this is something to be mindful of for the child tax credit. We'll see it further in the Trump accounts. We'll see it further for seniors, is that having a qualifying Social Security card number is going to be essential. Some of the old ways where one just had a qualifying child, and sometimes you could use either no number or an ITIN or something like that, and that would be potentially okay. That is going to be significantly restricted going forward under the beautiful bill. So there are some modifications going on there. So let's see the next one. This is a unique thing, and this is added. This is not something that was going to, didn't exist in the Tax Cuts and Jobs Act. This is a bonus deduction for seniors. And this is enacting a special $6,000 deduction for individuals aged 65 or older for the tax years after. So we have for tax years after December 31st, 2024. So again, this year we'll have one. This was retroactive to this year, and it will expire in 2028. But there is a deduction phase out for seniors with higher incomes. So if the modified adjusted gross income exceeds $75,000 for single filers or $100,000, then this deduction phases out. So this is generally for seniors that are retired and at lower incomes. There will be a deduction here, but those at the higher income amounts, those deductions will be phased out because there is a phase out limitation on this. So bonus deduction for seniors. This is also something to think about, again, with the income shifting with this deduction, potentially income shifting to a senior person. That would maybe not be effective if lower income senior qualified for this deduction. Income shifting to that person maybe isn't an effective strategy. Generally, income shifting to a person who is a senior person generally is not recommended in general, but this is another argument to steer in the other way. So that is helpful there. What else have we got? Moving on to number 8. And apologies, I am going through these a little bit fast, mainly because there are so many. We are covering, I think, about 14 points, via our sort of webinar here. There are vastly more things. There's also a vast number of things, such as clean energy credits and things like this, that are terminated in the big beautiful bill. So if you had a somewhat sophisticated tax return where you were taking making use of these things, it is a good time in summer to make an appointment with your tax professionals to review this, because some things may be there and some things may not be there. So that has changed. So one of the other elements of the beautiful bill, which just got a lot of talk in the mainstream press, is this no tax on tips or overtime. And it's essentially the creation of a deduction that they have. And it's a little bit complicated in the design of this deduction, but there are two parts of this. And it basically provides for tips, this maximum deduction of $25,000 for qualified tips received by both itemizing and non-itemizing taxpayers. This is an above-the-line deduction that's effective for taxpayers, again, after 2024, expiring on 2028. So essentially, there is this tax deduction for tips, depending on income, depending on a number of other factors. This one has gotten talked about because this is a little bit still in the workings of how this is going to work out. One of the key things of the deduction for tip income is it generally has to be based on an occupation that is traditionally a tipped occupation. So there was a joke going around for planners that we were all kind of thinking about. They said, "Oh, I've got a great idea. We'll do normal estate planning, and then amendments I'll just do for tips. I'll just get tipped income for whenever somebody needs a trust amendment. If it's just a simple amendment, they can just leave me a tip, and then I'll use this $25,000 deduction." That won't work. That will not work because under, when digs into the Act and then some of the proposed regulations for the Act, attorneys are not typically a tipped profession. Unfortunately, I wish they were, but they're not. We are not typically a tipped profession the same way, financial profession, legal profession, healthcare profession, doctors, not traditionally a tipped profession. There's going to be an occupation limitation there. So generally, what it's thinking about is a tipped profession like restaurant, service industry, automobile valets, other things. This is going to, my estimation is this is going to be kind of a hot button area of the law that is going to cause trouble for the administration. This kind of reminds me of the home office deduction, where the home office deduction always kind of causes a little bit of trouble, that people claim the home office to shield income, and it tends to trigger a lot of audits. I get somewhat of that deja vu all over again when I see this no tax on tips deduction, that there will be some questions about this. Also, it appears that the tips need to be marked via payroll, as in like traditional restaurant tips when people tip via the credit card, that let's say as a restaurant server, I'll receive my base salary, and then there'll be a line item that is the tip out income, and it appears that the FICA tax is still applied on this, so that on this tip income, I am supposed to pay the federal, like the Social Security card taxes on this. That will remain, but then on the income taxes, the deduction will apply. So this one, a lot of attention, could be helpful for a great many people, but the devil is in the details on this one. Exactly same concept is this deduction available for overtime of, again, for salaried employees, W-2 employees, this deduction of 12.5 to 25,000 for itemizers, non-itemizers. That means it's an above the line deduction. It goes up over there. And this is, again, this deduction for certain overtime work that would be calculated on the W-2 as overtime, that there would be a deduction here. And again, this one has a phase out, where if the individual is over 150, this will begin to phase out. The same way, as a couple greater than 300,000, there will be a phase out here. So these two are lively areas. The administration of how these are going to work is in process. This bill is actually only 13 days old. So this is a very new baby indeed. It's been around 13 days. So essentially everyone is still trying to digest the exact parameters of what's going to exactly happen in the administration of this. And so stay tuned on some of these. So let's go on to the next one here. This is another one of the parameters of no tax on car interest loans. This is essentially exempting interest on car interest loans through 2028. And this is essentially the vehicle has to be for personal use and it has to be assembled in the US. This assembled in the US doesn't necessarily have to be a US brand, but there's going to be rules on, is the US a US assembled vehicle? Is it deemed US vehicle? So this is one, there's a phase out again for couples over 200,000 or for individuals over 100,000. So this is another one where there is potentially a tax opportunity here to buy a car, but this is the parameters and the exact program on this. I was taking a quick look around. I am not really seeing any automobile dealers market this yet because I think they're still trying to figure out the exact rules and parameters on how this works. But if you are in the market for a new vehicle and your income as a couple is less than 200,000 or an individual less than 100,000, you may want to consider buying American for this new car, or at least assembled American. And this will be further defined as to what vehicles qualify for this. For example, let's say Hyundai Sonata, I believe, is generally manufactured in Alabama. Does that one qualify? It's a foreign brand, but assembly and a significant part of its manufacturers within the US. Is that one in or is that one out? This will be developed. And again, information on the phase outs and other limitations are coming. So something to stay tuned. If you are in the market for a car, perhaps there's a benefit coming here. This may be in play for you. So let's take a look at our next one. This is my favorite one because this one directly impacts us and is really the core area thinking for estate and gift tax planning, because there was a trap, there was a problem in a sense, or problem opportunity, crisis opportunity, crisis-opportunity in the 2017 Tax Cuts and Jobs Act. Tax Cuts and Jobs Act increased the estate tax exemption, estate gift tax exemptions to a base of 10 million. Adjusted for inflation as of this year, it's about 13,990. Very, very high estate tax exemptions. But those estate tax exemptions were not permanent. And so it was scheduled under the TCJA that at the end of this year, the exemption was going to drop back to a base of 5 million, adjusted for inflation, about 7 million. And so there was a lot of concern and a lot of work that was being done over the past few years after 2017 to utilize the Tax Cuts and Jobs Act significantly large exemption to try to maximize use of the exemption before it expired. Is often this entailed making large gifts to use that exemption, mainly because at the time there was an ordering rule from the IRS that basically said when you make gifts between 2017 and 2025, the gifts count against the the base exemption, not the extended exemption. So if I made a gift of, let's say, $7 million under the old law, that took out my permanent exemption. And then after 2025, my extended exemption expired and I had zero, even though I had what appeared to be a base of 13 under that ordering rule and that old Tax Cuts and Jobs Act. That a $7 million gift would have used all of my exemptions. Well, if you say, wow, that's complicated, I don't quite understand that, Mike, it seems, a little bit confusing. Well, good, ignore it. You don't need to understand it, because the new big, the big, beautiful bill permanently increased the estate and gift tax exemption for the year 2026 to $15 million. $15 million will be the base. So starting 2026, we're at 13.99 now. Next year, 15 million. And this is permanent now. There is no sunset. There's none of this bifurcation of the permanent exemption and the extended exemption, any of that. This is now permanent. So what does this mean? What should we be thinking about with this? What we should be thinking about with this is now really a great time to begin thinking about gifting, thinking about using these exemptions, because this is a very lawyery word, permanently increasing the estate and gift tax exemptions. Whenever we see the word in law that says permanently, we need a little asterisk beside permanently that basically says permanently increases until Congress changes it again. So this is permanent until Congress perhaps thinks otherwise. So if there, in the years hereafter, there is a significant change in the balance of power between the political parties, this may revert, and they may say, okay, after 2029, after 2030, we're going to go back to $5 million per person exemptions. That whole thing is over. So permanently is as long as Congress does not change this. The good thing is what permanently also entails, though, is that there's no built-in sunset. So it is $15 million. It is what it is. It's permanent until there's a law change. And that makes gifting much more predictable, much more possible. And it also makes gifting much more possible in that I can gift now, and I am not basically using up that permanent exemption. I can basically gift off the top and say, well, I'll gift, even if I make a substantial gift, I'll give $5 million. I'll still have 10. It came off the top. Under the Tax Cuts and Jobs Act, if I gifted $5 million, I'm actually left with 2. That's not so great. It only was effective to make really, really big gifts under the Tax Cuts and Jobs Act for larger estates. So all of those opportunities are now more available, and all the full range of estate planning techniques remain available. So all of these estate planning techniques of the grantor, non-grantor trusts, that all still remains available. So again, like what we were mentioning earlier in the webinar, thinking of income shifting is shifting income to other generations through non-grantor trusts, perhaps to, again, get access to greater SALT deductions and to avoid the itemized income or the itemized deduction limitation. That's totally in play. And what is in play is if I make this large gift, $1 million, $2 million gift, that's not really hurting me, nor is it as risky as under the old TCJA, because I've got 15 million permanent. It's just taking it off the top. Whatever remainder I have, I still have the remainder. So that is very good for things like income shifting with non-grantor trusts. It also poses a potentially interesting opportunity for doing non-grantor completed gift trusts to states like Nevada, Wyoming. These used to be called NINGs or WINGs, and they call it the Nevada Incomplete Gift Trust. Well, we can't do the Nevada Incomplete Gift Trust to avoid California taxes because California put the kibosh on that. California says if it's not a completed gift, it still is subject to California income tax. Well, what if we just complete the gift? previously we didn't complete the gift because it used my estate gift tax exemption. So I was a little bit, I have to make a completed gift. I have to use my estate gift tax exemptions. My exemptions may be only $7 million. That's, doesn't leave me a lot of wiggle room. Maybe I don't want to complete the gift. How do I square the income tax planning versus the estate gift tax planning? Well, beautiful bill kind of solved that. So how about we give you 15? Oh, 15? Yeah, maybe I could make a completed gift $2 million to the Nevada Completed Gift Trust. It's a Nevada non-grantor completed gift trust, and it can accumulate, income there. And then my son moved off to Florida, so he's in a no-tax state, and my daughter really wants to go to University of Washington. That's a no-tax state. And accumulate and then disperse to non-California residents. No state tax. Okay. That sounds, maybe that's in play. Before, because of the exemptions being up in the air, maybe not so much in play. So this is something that is very good for income tax planning. The thought for dynasty style trusts, again, generally outside of California, but thinking of the dynasty trust, if one is a higher net worth individual or a higher net worth couple, or critically, if you have senior parents that you say, gosh, mom and dad are pretty high net worth, we're pretty high net worth, my sister's pretty high net worth, start thinking total family planning, and maybe things like gifting or designing that estate to pour into a dynasty trust, a GST skipping trust. That could be potentially very effective. Why? Because the law sometimes changes. If the money isn't needed urgently now, perhaps I want to do planning for the long term to create these irrevocable trusts, settle the assets in there, complete the transaction, file the gift tax return or file the estate tax return, settle that. It's all locked up. And then in the future, if we have a significant change in the balance of power, and these, what Congress giveth, Congress taketh away. If Congress taketh away, I say, it doesn't matter. I dealt with that 3-4 years ago. It's done. It's all settled. When grandfather or father or mother passed away, it all settled into the trust. It's set. And we're just accumulating that. It's working just fine. So a lot of possibilities with the estate gift tax exemptions, a lot more clarity and certainty for planners. So for example, like the beginning of this year, I had a lot of clients come in and say, oh, I want to do the mega gift. There's going to be a sunset. And I'd say virtually all of my clients, I said, don't do it. Don't do it. We got to see what's going to happen with this bill. And glad I said, don't do it, because now we got to rethink how we're going to do it, because the good news is it's easier now and we have greater flexibility. So in the estate gift tax world, things are looking good. We're going to see that this can look very, very good in a moment. So let's go on to slide 11. This part also changed a little bit, charitable contributions. This is a little bit different now, is that there is now coming up for the year of 2026. It won't occur in this year, but there's now a 0.5% floor on charitable contributions for itemizers. So if you itemize, you now have to have charitable gifts that are over this 0.5% of the modified adjusted gross income. So essentially, unless one gives, so if I just give like $100 to the Red Cross, that's probably not going to be deductible if I itemize, unless it is my income is very, very low, because I have to cross that 0.5% floor on the charitable deductions. So this is something that may be slightly different for itemized people who itemize deduct as to their charitable contributions. On the converse, there's now a permanent deduction for charitable contributions for non-itemizers And there's a deduction up to 1,000 or 2,000 for married couples for certain charitable, qualified charitable contributions. So non-itemizers will have these sort of flat numbers that you could go up to those numbers, and you'll have this permanent deduction. Itemizers, there's a floor there. So charitable contributions will calculate out just a little bit differently than it's generally been calculating out. So a little bit to take a look at for charitable contributions. So let's see our next thing. Trump accounts. It wouldn't be Trump if he didn't stick his name on it. It's got to be. It has to be branded. It has to say Trump Tower on it and Trump accounts. So these are new. This is another new area, and similar to what I was mentioning for the car interest. This is, again, it's only been 13 days. These accounts essentially is providing a tax exempt, these Trump accounts, for qualifying children. And these accounts will be somewhat similar to retirement accounts, like an IRA account. And you can have these annual contributions of $5,000 a year. And then there's certain exempt contributions. And some of the exclusions are your employer contributions, and excludes your contributions from your beneficiaries' gross income. So essentially these Trump accounts are going to be like an alternative to 529 accounts, so that you'll have the 529 accounts, and then you'll have this option that you could do these Trump accounts and annually contribute into this account that does not, essentially, unlike the 529 account, does not have the education, or the funds have to be used for education. This can be funded at these levels, and essentially once the child is 18, and in some situations 21, they can just use what's in there. And that is a new structure, a new account that is devised by the big, beautiful bill. This is another one that I have not really seen this, the major financial institutions trot out the Trump account. Again, it's been 13 days. How they are actually going to operate on the Trump account is still, I think they're still defining their rules for what they're going to offer, how they're going to offer it, and how it will be available. So this is something that potentially can be a good alternative for people from the 529 account, particularly if one has a super funded 529 account and we say, that's pretty much full up. I still have young children. Maybe this Trump account would be effective. And let's go on to our 12.5 slide here. This is further of the Trump account. This is a controversial element. So for accounts, there's essentially credits available for U.S. citizens born after 2024, but before 2029, that if one establishes the account for basically newborns this year to 2029, there will be an initial government contribution of $1,000. So by opening this, well, you got to have the baby first and then open the account. But if you have a child born, this year until the end of 2028, there will be a $1,000 initial government contribution to seed the account. So that is very interesting. We have not really seen something like this. That's a direct, monetary payment for opening these accounts. Generally, things like IRA accounts, et cetera, are certainly tax preferred. 529 is tax preferred, but there's no sort of government congratulations, welcome new baby. These ones have that. If a family member happens to be having a new baby, well, there's $1,000 potentially for you. I doubt anybody will plan to have a baby to get $1,000 because the baby costs $1 million over the lifetime. But there's a little bit of encouragement for this account. And then there are penalties. Again, this is appears to be very, very highly regulated with regard to immigration. There are many, many sort of sub-provisions of this about improper claims where there'd be penalties and very significant things if the person does not have a social security card number, the person's not U.S. citizen, there's no benefit here. So this is an interesting developing area, and really one of the key areas similar to the automobile interest issue is to see what financial institutions, how they interpret this, how this is going to operate, because they will be the ones on the front lines administering it. So some interesting stuff there. So let's move on to, I think, our last item here. This is another favorite. This is one for tell friends in the Silicon Valley area, or if it applies to you yourself, the qualified small business, essentially deduction expansion. And so essentially what QSBS is this is the US tax system saying, we love qualified small businesses. We love American C Corp startups that employ Americans, and the gross asset threshold could be actually to be considered a small business. They increased this. It used to be your small business, the gross asset threshold at founding had to be below $50 million. Now it could be below $75 million. And essentially what this said is that if you form a startup, a C Corp, and you're forming the startup, and you create the startup, and and it's a C Corp, and it's qualified. It's basically a company that is not like a real estate business or something like that. It's actually doing active business like a tech startup, something like that. That essentially each taxpayer owner gets a capital gain exclusion that used to be $10 million, is now $15 million. So if I form the company and my basis in the stock, we'll just use raw numbers, 0, and my fraction of the company, someone will buy for $15 million. I basically, on my return, could say plus 15 million minus deduction 15 million, and I pay 0. So I can sell my interest in the company, and I would have pay no capital gains taxes. There's also some partial benefit also in that the holding period used to be I had to hold the stock for a period of 5 years, but now it's if I hold for less than that, if I hold over 3, I can get a partial benefit from this. So basically what this QSBS item is anybody who is involved in sort of active business, active startup, explore QSBS qualification early, because if one is holding QSBS stock and there's going to be a liquidation event for a company, and the stock's going to be sold, or there's going to be otherwise a reorganization event, this can save you millions of dollars in taxes. This also can be coupled with the permanent estate tax exemption. So if, let's say, I say, well, Mike, actually, I'm doing so well, my share in the company is 30 million. I can generally gift half of it to my, usually my daughter via a trust, via a non-grantor trust. She basically would then be entitled to the benefit also. And so I and the non-grantor trust for my daughter could benefit from the liquidation event, 15 million free for me, 15 million free of capital gains tax for her, and then that gift to her, yes, it did use up my estate tax exemption. It used up my $15 million. Sure, I'm over. It's my remainder over, but I just put $15 million capital gains tax free and estate gift tax free into an irrevocable trust that if I designed it correctly, or perhaps Dynasty Trust, there will be estate gift GST tax exempt forever. And I didn't pay any capital gains tax on it either. That's a magical thing. So anyone involved in that startup business creation space, there is really great tax opportunity here. Why, as a matter of tax policy, do we like this? Because we want people to go and take risk and start these companies. Why? Because they really, we live in Silicon Valley. We know the answer. They drive the future. So there's a lot to be done there. That's, of course, massively complicated, but something to have as an issue spotting item on the radar. So I think as of QSBS expansion, I think that's our last item.
Yes, it is.
Well, great. Well, it's been I know this was a sort of massive, like, rapid fire, this, that. I will be honest with you all, we hit like 20% of the big, beautiful bill. This is probably, like, is it half? We're not even close to even half. We're less than a quarter, I think. There's a lot. It is a big bill. It was, classic, like the Trump negotiating thing, is say, ask for everything. Say, I want every single thing. I want every single request. I don't want to ask for 5 things. I want to ask for 500 things. And if we get 300, I'm happy, and that's basically what ended up happening. There's like 300 things in here. So start early, because again, we're really right in the middle of the year. Explore this with your tax professionals. Read about the bill, and start getting up to date, because there is a lot of good planning that can be done over the next few years, and with much greater predictability and reliability, because at least on the estate gift tax area, we don't have a sunset, so we aren't dealing with that. But other areas, there are sunsets, such as the salt deduction and other areas. So definitely things to take a look at. So that can be the summer reading of reading the big, beautiful bill. It also is a massively long bill as well. So you could read the synopses that many people have put out, and you'll be well served.
And I think, as Michael mentioned, stay tuned for more updates. And in the fall, we probably will host another webinar to provide more updates for our audience, right?
Critically, and this is also the key thing that generally happens with these bills, is that the IRS now has to digest this. So in national office out in DC, all of the IRS CPAs and lawyers basically have a big, basically bound copy of this bill, and they're going through trying to do what's called writing the regulations, or basically the taxpayer advice memorandums, basically trying to interpret some of this. Basically, well, how does that Trump account really work? How does what actually is considered like an American manufactured car, and that's going to guide some of this as to the specifics. So, if I just go out and I just buy an F-150 truck, I don't necessarily, I need to be certain that that's actually going to qualify. I mean, it seems like it's an American thing, right? It's an F-150 truck, but we don't know until we know. So again, it's been 13 days, and this will firm up, week after week after week as the year goes by.
Great. Okay, thanks again, Michael, for presenting for us today, and thanks everyone for joining us. And if you missed today's webinar, in the night, actually at 7:30, we'll have a Chinese webinar. We'll present the same content, but if you speak Chinese, you understand Chinese, feel free to join us in the night as well. Okay, great. We hope you have a great afternoon. Thank you for joining us again.
Great. Take care all. Bye-bye.